Hey, John.
Nick, how you doing?
Oh, not too bad. So when do you need to be out of here by?
Like 12:50?
Okay, yeah, that won't be a problem. That's cool. Get you out. Get you out for 12:45.
All right.
Where do you have to be?
I gotta meet a guy at Richmond and then we're going to Barry.
Okay. Hey, Chris. How are you? Oh, not a whole lot. Just busy around here. It's never ending.
That's a low.
Good morning.
Morning. Just gonna give a couple more minutes. I thought Daryl was coming and this will probably be a relatively quick meeting today. John's gotta get out a little early. So,
Sign this, I can't take and watch your signature.
what is it?
That's what you you signed it. Here, Nick, just sign here.
Yeah,
Thank you.
it's my stole.
You guys get federal funding?
Yeah. Yeah. Yeah, it's been an interesting time. To say the least.
Has there been communication?
No, the FTA is not, who provides, the majority of our funding has not been very, they're all wondering if they're gonna have jobs, too,
Right.
so. There he is, the man of the moment. I was wondering if you're gonna, right, look, you have
Wow.
52 seconds to spare.
You saying I'm late?
No, I'm saying you're right on time. How are you doing? Dale?
Precision.
Oh. Alright,
Where's everybody?
well, Clayton is not gonna be able to make it, I don't think Nate's not gonna be able to make it. So, the really only other person is possibly, our board member who was a maybe. But I think we should just go and get started. The only thing, we have are the minutes, so. Stephanie or Chris, if someone could, approve those minutes, that would be great. They are in the board packet. I think you were both at the last meeting, so.
I did not read the minutes. I could approve them without reading it, but that doesn't seem right.
Well, you're the only other, and if you wanna, we can come back to the minutes if you wanna just take, they're only like a page or two, so we
Alright.
can revisit that at the end of the meeting if you need some time to take a look at them.
I'll take a quick look right now.
Great, thank you. So then, in that case, I will turn it over to John. John did send me some additional materials. I haven't pulled up, John, if you wanna talk about the emerging markets fund.
Sure, yeah,
But,
yeah.
and I think we all know what the FI 360 report does, so,
You want me to
we don't need
explain it?
another recap on that. I think
Okay.
everyone's well aware. I did email out the FI 360 report and I will share it right now. So it's on everyone, in front of everyone, so John, let me know if you want me to.
Yeah, the funds are all doing great except for the BlackRock, which we've been talking about for a couple quarters. And so I
Okay.
wanna really focus the discussion on that.
Okay, great.
There's really nothing else. The real estate fund is at 51. We've beaten that one up enough, I think.
Well, again, I think the index funds are.
Yeah.
They're mirroring a benchmark, so I'm not concerned, or I don't think
Yeah.
we should be concerned about those.
So we have, I mean, if you just wanna show that, there it is. It's in the
Yeah.
third, it's 76, which is the first percentile into the fourth quarter quartile.
Yeah,
But still, it's been there, and I think that we said that last time, if it remains here, then we would move forward on an alternative. And so,
yeah, I don't know if I think we should talk about it again, but again, you're the investment advisor, but, yeah, what are your thoughts on that? Go ahead.
I have a couple, I have several thoughts. One thought is, do we really need an emerging markets fund? That's one thought.
Yeah.
We would be fulfilling our fiduciary duty without it.
Mhm.
I believe we've got, I think we have the American Funds Euro Pacific Fund in this plan, which is, and the difference between the Euro Pact Fund and an emerging markets fund is that emerging markets fund is more global, and takes into consideration underdeveloped economies as opposed to the mature economies of a Euro-Pacific group. So by nature, this fund class is volatile. It's exposed to geopolitical risk. I think those risks are only increasing now. I think we should have the fund. I think I like having an emerging markets fund because, well, I mean, everybody has been down on Euro-Pacific or particularly the European markets. And those markets are outperforming all the US domestic markets year to date, pretty strongly. So, you know, if there's some tolerance for risk and understanding that you shouldn't go, you know, all in on emerging markets, I think it's a good way to kind of take some incremental stock risk that you don't get in other funds. So that's my case for having an emerging markets fund. There are, and it has been a difficult time for emerging markets in general, primarily because of the US dollar. When the dollar is strong, emerging markets economies suffer to pay their typically dollar denominated debt. So things are more expensive for emerging markets economies. And so as a class, this fund group has been underperforming the broader market. BlackRock, in addition, has more so underperformed the emerging markets sector. And we've talked about this in the past. They were exposed to some fair amount of Russia stocks when I was going to say Russia invaded Ukraine, but I'm not sure I have that narrative right. But let's just say that Russia. I'm sorry. I'm a little peaked on that matter, but Russia had to the funds writ large had to divest themselves of any Russian companies and exposure per order of the international community sanctioning Russia for its invasion. And so BlackRock was caught behind in that, and so they ended up having to sell at distressed levels. That's what originally got us talking about this fund. In addition, they have made some less than stellar bets in China, which has also contributed to its, you know, fourth quartile rating. So I've got and maybe, you know, Nick, you might distribute the research.
Yeah.
Maybe we don't have to reach a conclusion on it today or whatever, but there are 4 other emerging markets alternatives that are scoring well.
I think I have it up here. Can
Oh, you do?
everybody see this? I'm not. Do you see something that says American Funds New World? I just want to make sure it's switching pages for you. Okay, let me reshare that. Let's see, where is it? I think it's this right here. Okay, do you see something that says American Funds New World?
Yeah.
Now, okay,
Yeah.
great, thank you. So go ahead.
Yeah, so I'll just take them in turn and say that, well, you know, there are funds that are generating positive returns in the emerging markets world. You can see under the 1, 3, and 5 year. Those are on the right side of the page. Those are percentage returns. And so you know, the American New Funds is returned 6.46%. You see BlackRock has been negative for the past year, and the other three, Dodge and Cox, GQG, and Vanguard, all respectively, have posted positive returns. So American Funds New World is thought by some to be an emerging markets fund, but I don't think it is, and I don't think that we should consider it. And the reason is that American Funds allows up to 25% of US exposure in this fund. So it's not really an emerging markets fund. And when you look at the top 10 holdings, it looks like a tech fund.
Yeah.
You know, so I don't think that's and if we had that fund in this plan as an emerging markets alternative and felt good about the fact that it was was scoring well and was generating positive returns, we would be overlooking the fact that most people who might take to put a toe in the water on American Funds New World would simply be doubling up the same stocks that they own in other funds in the plan. So I kind of put that aside. Then we have Dodge and Cox, GQG, and then Vanguard. My eye naturally goes to the Vanguard and says, wow, like it's in the top, it's a top performer, it's positive 11% amid what looks like sort of not great returns on the other funds. Let's just go with that. And then as a kicker, the expenses are super low. The expense ratios for all the funds are in the far right column. I've circled the Dodge and Cox at 0.7. That's just as a point of reference. But the below that, emerging markets, Vanguard Emerging Markets is 0.14%, very, very cheap. Okay, so why wouldn't we choose that fund as an easy one? I don't like it because, well, I'm a big Vanguard fan. We benefit in this plan from a bunch of Vanguard selections. But when it comes to something like emerging markets, I think it's really important to have an active manager. And Vanguard is not. Vanguard is so-called passive management. We've talked about this in the past, and I'll keep this brief, but the difference between active management and passive management is as follows. With an active managed fund, you have a team of analysts who are considering different investments, and they are trying to outperform the market. And they do so by digging in with research, fundamental research, and technical analysis of the market. They might reach out and interview company officials. They might take be on analyst calls and really kind of parsing quarterly returns. So they're trying to outperform the market, and they're being paid to do so. That's active management. Passive management, which is what Vanguard employs, is simply putting together a fund that is reflective of what's happening in the market. So imagine an active management, you got a building full of analysts trying to outperform the market. In a passive fund, you've got one Vanguard guy with a bank of computers who's creating a fund that is simply a reflection of what has happened in the market. So that is thus passive. And so that's why it's really inexpensive to own Vanguard. And in most cases, and in fact, historically, passive has outperformed active. Active is more expensive. But when it comes to something like emerging markets, I think it's really important to have an active manager because of the risks that I was talking about earlier, the geopolitical risk in particular. So if you've got something like a world event where something turns, and all of a sudden a country like, say, China puts some severe restrictions on Western ability to invest, or let's say there are tariffs that are coming. You want to have a manager who's capable of making discerning decisions real time and sort of exercising a sense of conviction about what's in, what's out, what's favorable, what's not favorable. With Vanguard, it's the difference between being a price taker and making those decisions. So for that reason, I think Vanguard, and sorry for the long-winded explanation, because by all rights, that looks like a really good choice. Then we're left with Dodge and Cox, and GQG Partners. There's research behind this page, that I emailed to Nick, and maybe he could share it with those in the committee who are interested. But I prefer, and I'll, cut to the chase, I prefer Dodge and Cox emerging markets. The reason why you don't see a history of returns is that this is a new fund. However, it's not without track record. This fund, and you can read this in the research report in the Morningstar page that I've included. It's comprised of funds within a set of 4,000 funds that Dodge and Cox as an institution has known, has analyzed, and is very familiar with. And so it's while it's a new grouping of funds of stocks in a fund, it's not per se a new fund and a new effort on their part. It looks a lot more like a traditional emerging markets fund than GQG does. The GQG fund is it's quite untraditional, and for that reason, I don't love it for a retirement plan. You can read about that. I don't think the details on that are really important, but you can read about that in the one-page Morningstar report. They tend to shun a lot of what is typically regarded as, down the middle emerging markets choices. So for that reason, I like Dodge and Cox. I like as a firm, I like their track record. Their expenses are, although quite a bit more than Vanguard, are less than the existing BlackRock. That's another knock against GQG. Those expenses are very high, and I can't really come up with an argument to justify why would we pay almost twice in expenses for that fund. So long and short of it, I'm recommending that we make the move for BlackRock and go to Dodge and Cox. And if the committee chooses, if we want a little bit more time to kind of think this out, then we can kind of consider this maybe for this meeting's notes, Nick, and make the final decision next quarter. I don't think we're any better or worse off doing that. The one argument that I might say is, well, it's in the 76th percentile. It's not like a bottom performer. And you and I have talked, Nick, that BlackRock is traditionally a really good family of funds. So the one final piece that I'll say is I know that it's in the data from the regular FI 360, Nick, but I don't have that at hand. Important question: how much money is in this fund?
Yeah.
So I don't think it's a lot. In fact, I think it's like 0.25%, right?
It's like between the two plans, 160,000
Yeah.
out of the total market value of 13 million
Yeah.
Okay.
in
About a
20
20%.
participants.
20 participants. Okay.
Mhm.
So average balance of 8,000.
Gotcha. Yeah, how many assets are in the entire fund?
13 million.
No, I'm talking about for the Dodge and Cox versus the BlackRock.
Yeah. Let's see.
So this has 4 billion in BlackRock, and there's only half of 400 million in Dodge and Cox.
Mhm.
Interesting. Yeah,
It's such a weird. I won't say it's weird. It's the kind of the most tricky fund sector. You know this, Nick. It's
Yeah.
sort of the most tricky fund sector you gotta get a handle on. Like, when you're looking at US large growth funds, it's pretty easy to distinguish one versus another. And so, like with a 2 billion fund versus 400, is one better than the other? You might say, well, the 2 billion fund is big and established, and that's great. But then it's an emerging markets fund, and you want to be nimble, and you want to have positions that are liquid and won't move the fund to trade. So it's it is a little bit, it is definitely unusual to be looking at an emerging markets fund in the context of the way we typically look at fund analysis.
we had the Lazard Emerging Markets Fund when we were at the state.
Yeah.
Have you ever looked at that one?
Yeah, I had actually. That one didn't pop up in this, but I think that might be a good Think
Yeah.
we revisit?
Yeah, I think
It's a good fun.
I think we should probably, give it a little bit more time. I mean, the thing for me is the 10-year. They're still in the top quartile almost of the 10-year
Yeah.
return. They haven't gotten a new manager. It's still the same manager, you know, it's just, I would hate to pull the trigger, you know, as we've talked about, a lot of times these funds tend to revert to the mean.
Totally.
And so they underperform for a little bit and then, you know, I mean, the Russia thing is is a little concerning that they didn't get out of that before, but no one's perfect. So I would say, you know, we definitely keep it on watch and maybe we keep revisiting this. If I start seeing yellow and red in the, you know, I get the other thing with the Dodge and Cox is it's got a 3-year track. I mean, the fund's only got 3 years, is
Yeah.
that correct? So it's just, you know, I would love to see a longer, I mean, Dodge and Cox is a very well-known fund family. I mean, they do a lot of other, they have a lot of other funds, but yeah, I think, I don't know if anybody has any other thoughts on that, but I just don't wanna pull the trigger, you know.
I think
super
that's
quick,
smart.
and it'd be one thing if there was a significant amount of assets in this plan.
Yeah,
But like you said, there's a fraction of a percent in this, and I think the other question is like, I think we should offer it, it adds diversification to folks who want that exposure, as long as they understand what they're getting themselves into, and I certainly think if we're seeing people putting half of their portfolio in this, we should call them,
Yeah.
you know? So, but,
So Europac and BlackRock aren't redundant, like, would it make sense to move BlackRock, just map it into Euro?
I think that's a developed markets fund, so that's more, you know, EFA than it is emerging markets, so that's. I think I mean, the question is again, do we wanna offer this? I think the answer is yes, as long as people understand what they're getting themselves into. So, do you feel comfortable giving it a little bit more
I do.
time?
No, I think that's smart. I think it's smart to be very deliberate when we're doing this because of what your comment about the tendency to revert. I like the idea also, thank you for mentioning the Lazard. As I say, it didn't come up when we searched. But I have worked with that fund in the past and it's a good one. So I think that's a good kind of next step to revisit, see how the scoring looks next quarter and see how this overall picture looks next quarter as well.
Yeah, because what we have to remember too is that this fund, and the management hasn't changed. Here, this is what I usually do when I'm looking at funds here, is I go to the Morningstar, which is what you're pulling. But if you look at like previous years, you know, I think they, like in 2017, you know, they were, you know, 2017 top decile, 2018 top
Yeah.
decile, you know, 2019 top decile, 2020 top decile, and they have the same manager, I think. You know, it's just the last couple of years where they've really not done well.
Yeah.
Year to date, they're in the top, you know, third almost. So I just want to make sure this is BlackRock. So, so I think maybe we should, again, because there's not a ton of assets in this plan. We might want to just give it a little bit longer, to see, you know, if they revert to the mean, before going forward with a change that is gonna create more work for Daryl, gonna create, you know, then we're gonna have to, you know, let people know. Do you know how many participants are? 20, okay. And let's talk about what that process would look like. You send out a letter, what's
So the
the
1-page fund change notice has to
Okay.
be distributed 30 days prior to the change.
Okay, gotcha. So it's not that much administrative work to do.
It's nice to time it so that this notice can go out with the statements, so we could time it for May 1st, for example. We could
Okay.
mail it out with the March 30th statements,
Gotcha.
but if you can't, it's not a big deal to do a separate mailing or.
And John, how many people How many of your plans actually have emerging? Do they all offer emerging market funds?
Kind of our model to
Yeah.
offer it, yeah,
Okay, gotcha,
yeah,
yeah. Do any of them have the index in there?
no,
No, okay. It's funny because it's got the best performance, which you
Yeah.
generally don't, typically people think they can outperform emerging markets more than say like an S&P 500, but yeah, so. Any thoughts, from anybody else on this? Okay, yeah, I think let's give it a little bit longer. We'll keep it on watch and John, let's talk too about, possible alternatives.
Yeah.
A little bit more,
perfect,
cause I think, like you said, the GQG is weird and we don't wanna consider the index. So maybe if we had a couple more options.
Yeah.
Beyond Dodge and Cox, we can talk about that, so.
perfect,
Alright.
that's good.
But other than that, all the other funds are doing pretty well.
Yes,
Okay,
everything looks just fine.
okay, good. Okay, anything else, before we jump to, I think we were gonna talk about, upcoming events for maybe having you on campus or anything else, but Daryl, do you have anything that you need to talk about?
I just wanted to ask, are we on hold with the Roth employer contributions to the retirement plan? No, there was some
Yeah,
follow-up discussion.
we've talked and again, that's for, the employer side. We've been looking at that from a payroll perspective. It doesn't seem to be as easy as we, had hoped. I think Tammy might have reached out to you
Yeah,
on
I had
that.
a discussion with her about it.
We wanna, of course, go down this road of being, we wanna give people as much flexibility as we can. But I think we need to do a little bit more research on that. Just to remind everyone, one of the new legislation items that came through with the Secure 2.0 is that you can now choose to have the employer contribution, so the match that the company gives you, that quarterly match that a lot of folks get between, say 5 and 7%. That could now be, you could choose to make those Roth contributions from the company, so meaning you would have to pay the tax on that. The company wouldn't pay the tax on it, but you could make those Roth contributions, and what that allows you to do is essentially when you start pulling those funds out in the future, they'd be tax-free withdrawals. So all the earnings you get on those in the future would be tax-free, but you would have to pay the taxes on it when the company makes the contribution. We're just finding from a payroll perspective, it can be a little dicey with the current system on doing that. So it is an option that the company can choose to provide or not to provide, as far as I'm aware, right, Daryl? That's not a mandated
No.
benefit.
It's optional.
So I think we do wanna provide that, but we just need some more time to kind of figure out how we do that internally, from a payroll perspective. Does that make sense the way I explained it? Is there any questions on that benefit? Chris, do you have any questions? You're on mute.
No, I don't.
Okay, great. So hopefully we can provide that in the future. I think we need some more time. We're also down a person in my department right now who's that position does payroll, so I think we need a little bit of time to think about that. So hopefully we can provide it in the future, because I think it is a good benefit. I'd like to honestly take advantage of it. But it's just payday that wasn't super clear on how we could do that, the best way to do it without making it a tremendous lot of work for everyone involved, so.
Because of the way we calculate the employer contribution, so they accrue it bi-weekly,
Yeah,
but then we true it up at the end of the quarter and you make one contribution
yeah, exactly,
4 times a year.
yeah,
So it really impacts your payroll person
Yeah,
more than anyone else, like the record keeping on it. Is not, won't that be that big a deal for me? Schwab doesn't care, they've got the coding for it. Assure's got the. It's like a memo code or something, so they can handle it, it's just,
yeah, it's the true
Doing
of
the
that
one-off.
one off, yeah.
four extra payrolls a quarter, a year. For the people that want the Roth contribution.
Well, and the thing is like you can easily do the Roth, choose to just do more Roth contributions on your contributions too to make up for it, I guess, so it just, I mean.
True.
It's definitely more attractive for folks earlier in their career, so.
Okay.
But yeah, more to come on that in the future. Anything else, Daryl, on the record keeping side? That you have?
Not for me, no.
Okay, the plan is in pretty good spot in terms of like any changes we need to make or update plan documents or anything like that?
I'm working on that amendment, I hope to have it today. I didn't get it done, but to add the discretionary employer contribution for employees
Okay,
that aren't making 457 contributions.
oh, okay, gotcha. Yeah,
It's effective July 1.
gotcha.
Awesome.
Okay, so John, do we wanna chat? And this is more of a, maybe a you thing as well, but, when was the last time that you came and did like in-person meetings?
Stephanie, I wanna say it was like towards the end of, was it towards the end of 23?
Yeah, it's been, yeah, I don't know, we didn't do them all in 24. I don't know if I have those dates right in front of me.
John, we need to talk to you up here. If we're spun off to RCT, what does that do to us?
Well, I can answer that, so,
Okay.
I think the timing of that is probably in the future, so you probably would still be able to, in the short term, do another, thing with you on site up there, but.
Yeah.
And I'll fill you in on what's going on in some of our other areas afterwards, but
I
Chris,
managed their plan though.
oh, you manage RCTs? So,
Yeah.
so John would probably, there wouldn't be a whole lot of change for you than Chris, so I didn't realize you manage RCT's plan.
Yeah.
Oh, okay. So, well, that's good news, you'd have the
Hey,
same.
good news.
Unless you wanted
Everything
to,
stays the same.
unless you were sick of me.
No, that's great, it's great.
John, to go back to that original question, it was in the spring of 23.
Yeah, been a while.
Okay,
I always want to ask, like, do you ever have like an employee day or anything like that?
Not really, it's really difficult to get most of our employees all together because
Yeah,
of our driver schedules. It's not like everyone takes lunch at the same time or anything
Right,
like that
right,
nature.
right, yeah. I just thought maybe there'd be like an employee safety day or some of my clients have that,
Fortunately, we
Okay.
don't do anything of that nature.
Yeah.
well,
Well, the good news with that is that it's wide open. We can come in anytime.
okay, great. We'd wanna obviously have some time to advertise that and set it up and hopefully make it as well worth it, your time as it is for the employees, so I don't know, what you did last time, or how we promoted that last time. But I leave that up to really.
Stephanie, I'm sorry, Nick. I'm trying to remember.
So we
I
did
see.
one session at all 3 locations, so
Yeah,
St. Albans, Berlin, Burlington, each had 4 hours scheduled. And
Yeah.
then we broke up those 4 hours with time slots that employees could sign up for.
yes.
And what I
Amazing.
I don't seem to have the signups. So I don't know how full your time was. I also don't know if 4 hours was too little or too much at some of our locations.
I don't ever remember, I don't have any recollection of there being more people that wanted to see me than couldn't see me.
Okay,
Um,
I remember Burlington, I feel like your list was full and you were doing like either 20-minute time slots. I don't have a sense of how it was in Berlin or St. Albans.
Berlin was not full at all.
Okay,
St. Albans, I met with a fair amount of people, as I remember.
so maybe it's
But
a,
to your question, like, or to the time. Personally, I think. And you'll know this if you go out and you canvass interest, but. 4 hours is it's kind of a good amount of time. If I'm meeting people back to back or 20-minute slots, like. I kind of get gassed. I'm not the young sprightly guy I used to be. But I mean, really, it's really about, please know that it's about giving your people what they need. I just, unless we hear differently when you gauge interest, that seemed like the right amount of time
okay.
last time.
I do wonder for our rural locations if we should maneuver the time a little bit instead of 9 to 1, which is what it was. Maybe it's a 10 to 2, and you might capture more people.
Yeah,
Giving off those split schedules. Chris, do you have a
Sure.
sense of if 10 to 2 is better than 9 to 1, or do we do like a 3-hour block instead of a 4-hour block for your location? Because you are the smaller location.
Right? Can you hear me?
Yes,
Uh, every day is just a little bit different, but almost the same, so. We're all done care partners around 9:30, so if that fits in anywhere.
yeah,
yeah. I wonder if we would change Berlin to like 10 to 1. And then keep the other 2 locations the same.
Alright,
But yeah, let Nick and I work on, maybe we'll present it to the directors next week on what we think might work best, and then we can get some dates scheduled.
sounds great.
okay, great, so we'll get back to you on that then. Well, in the interest of time and John's got a tight schedule today, I don't really have any other items. I think, we'll continue looking at that fund. The good news is 90-something% of the funds are doing well, so no changes really needed there. And Stephanie, yeah, let's talk at the next directors meeting, see if we can come up with a best case for getting John on site. But does anybody else have anything that they wanna chat about in regards to the retirement
Are
plan?
we worried about any of these tariffs messing us up?
I'll let you go with that, John. I got my own thoughts, but you're the advisor.
I just like, I'm pretty mystified when I hear like people talking about tariffs and how they're gonna benefit our economy and how they're gonna be good for stocks. They're not, they are by definition, inflationary. They increase prices and they result in, retaliation. However, you know, when the administration saw that on announcement of 2% backup in the markets, they immediately, pulled back on their commitment to impose 25% tariffs. Eventually, I think that, yeah, I don't know. I mean, don't you worry about your credibility as a nation? So I worry about tariffs. I worry about the sort of the way that they're thrown around as a negotiating tool. I think it's too serious a matter to treat lightly, and I think that it compromises our credibility as a nation. That's my personal view. So far, the market is not responded to, other than that one pullback. Yeah, I'm really concerned about tariffs. I think they're really bad for economies and markets. Stand by. We'll see whether or not the concern bears fruit. If they're implemented to the widespread degree that they're threatened to be implemented, I think that will have negative consequences for sure.
Hmm.
What are your views?
I agree with everything you said. So, I mean, I think the other thing is like, you always lose time in the market, right? Time out of the market is more dangerous than time in the market. So I wouldn't be going and drastically changing your asset allocation or your portfolio based on that, right? So,
Yeah.
yeah, it's one of those things where, you know, there's always gonna be a new administration, and again, we've seen based on what you said, as soon as the market went down 2%, you know, I think they're just using it as a negotiation tactic more than, you know, actually putting new tariffs in place. I mean, 20% tariff on Canada would do so much damage, and Mexico, to the country, that it would be hard for that administration, I think, to stay in power. Well, or to keep like the House or the Senate, like people would lose their minds. We get so many things from Canada, from lumber to energy to, you know, metals and mining, like to tariff that would be just incredibly detrimental to both economies. No one would come out a winner in that situation. So I don't think they're very likely. I think they're just being used as a negotiation tactic.
Yeah.
So. Okay, great.
All
Well,
right,
thanks, everyone.
Amazing.
Have a good day.
Thank you guys.
all right, thank you.
Bye.
You will.
Bye.